Delayed for a week, but now it's out and giving the markets a big boost. The highly anticipated consumer inflation report for September coming in better than expected, with growth of 0.3% month over month and 3% from last year. Joining me now, Bank of America Securities Head of U.S. Equity and Quantitative Strategy, Savita Subramanian. Savita, great to have you in the studio. Thanks for coming by.
Great to be here. Yeah, interesting times.
Yeah, indeed. So, as you've said, CPI, only one data point, but you have a broad range of indicators you look at, and you're concerned of what you say is a mispricing of inflation. Can you explain that?
Sure, yeah. So there's a few ways we're looking at this, but if you think about what the Fed is doing on the short end of the curve, that's great for affordability of short end priced assets, so auto loans, et cetera. But if you think about the broader kind of asset market and housing, they're all priced on the long end of the curve. And what I worry about is we're in an environment where there still is a lot of pent-up activity that corporations want to execute. If this happens and we're cutting interest rates, that sort of sets ourselves up for a little bit of an inflation surprise, which could push up the long end of the curve.
So the 10-year bond yield goes up, and that means mortgage rates go up along with it.
Right, exactly, unless we get some kind of yield curve control or other techniques for managing that end.
Now, one interesting thing, you said that this could be a good setup for energy stocks. Of course, there's a lot of moving parts. President Trump put sanctions on Russia, which sent oil prices higher.
Yeah.
But then they fell.
Yes.
Tariffs are playing into this too. Put it all together for us.
Indeed. I mean, I think energy stocks, especially the big ones, have kind of decoupled from oil prices. So what we've noticed is that since these CEOs and the C-suite is no longer paid on productivity or on production targets, what we're seeing is that these companies are much more disciplined about extracting oil out of the ground. So they're really more focused on cash return. And it's interesting to see that the capital intensity of your average oil company is the same as the capital intensity of a big tech company, which is a big switch because we tend to think of tech as asset light, high margins, no problems, no asset intensity. And now they're starting to become more asset intensive, which I think is an interesting wrinkle.
Yeah, it really is strange. I mean, it's so expensive to get oil out of the ground, spend all that money and everything, and Facebook, it scales perfectly, right?
Exactly.
And yet you're saying that the cash involved here is about the same for the two companies, but
exactly.
Energy's so much cheaper.
But energy is trading closer to its lows, and tech is trading at all-time highs. Yeah. And I think that is, potentially because investors see the best growth opportunity in tech companies. But if you think about energy and you think about all of this, the hyperscalers building out physical capacity, that requires not just electricity, but also oil, gas, other avenues. So I think unless we head into some kind of a recessionary environment, oil stocks could do really well.
Sounds like a great setup. Speaking of tech prices, there's all this talk of an AI bubble or some kind of froth. You look at a lot of different signposts that say to you, maybe we are getting frothy. What ones are saying, yes, there's a danger sign, and what ones are you watching that haven't yet turned?
Right. So the indicators that we look at that have recently inflected in a negative way are things like credit complacency. So if you look at what's happening in the credit market, there are the events happening. But when you look at spreads, the volatility and the tightness of the spreads suggests just real complacency in credit. So maybe these investments are underpricing the real risk. And then on top of that, when you look at the performance of expensive, more speculative stocks versus inexpensive stocks, what we found is that towards the end of speculative bubbles, you tend to see a really strong outperformance of high PE or high price to earnings versus low price to earnings stocks.
Sounds familiar.
Which is precisely what we're seeing today.
Okay.
You're seeing meme stocks. You're seeing a lot of speculative areas of the market really burgeon. And that generally is something that...
I think economists call it a flight to crap.
Flight to crap,
That's
right.
the academic
Dash
term for
to
it.
trash. Yeah, exactly.
But there's something that hasn't turned yet, and I found that interesting, sentiment.
Sentiment is still relatively contained for the broader equity market. So while we see pockets of euphoria and things like AI, power, the average equity strategist, my counterparts and myself, are recommending that you put about 55% of your portfolio into stocks versus cash and bonds. That's not that high. Back in the 2000 peak, we saw strategists, backing up the truck on equities and putting over 70% of their recommended assets. So I think we're still in that wall of worry type of environment for the broader market, which is why I think the average stock in the S&P could do really well over the next 12 months, but the index might be a little bit more constrained.
Maybe we'll see S&P 7,000 before the end of the year. Thank
sure,
you.
Never say never.
Savita, thanks so much for coming by. Appreciate it.
Thank you.